Good afternoon, everybody, and a warm welcome to Reverse Mortgages, one of my favorites for you to learn. I'm Cindy Bishop with Cindy Bishop Worldwide, and it's a pleasure to introduce our esteemed master instructor for today, Kelly Katalinas. Kelly is a seasoned mortgage loan officer with over 3 decades of experience. Kelly has not only excelled in her career, but has also become a leading lender and branch manager. Her expertise extends to training agents and lenders, enhancing production and cultivating lead generation. She's super good at it. In recognition of her outstanding contributions, Kelly has been honored to receive the Lifetime Achievement Award by the Washington County Magazine. Additionally, she has received the 5-Star Professional Award for the fourth straight year, which was bestowed upon 3 out of 4,600 individuals in the Washington, D.C. area in 2024. These are just a few of the many professional awards and accolades that Kelly has received, and you'll see why in just a minute. What truly sets Kelly apart is the trust and admiration she's earned from her clients and agents, with over 95% of her business coming from referrals. Today, Kelly will share her expertise on reverse mortgages. Without further ado, please join me in extending a warm welcome to Kelly. Take it away.
Thank you so much. Always appreciate such a nice welcome. And I'm so happy to have everybody here. This is a topic that I think is gaining a lot of momentum. We're going to go through the slides. It'll talk a lot about the reverse mortgages, what they are, but keep in mind, as real estate professionals, this can be used for home purchases, those that want to downsize and move into a smaller property and not necessarily use all of their equity and pay cash for it, but have the home that they need and want without having principal and interest payments. So as we go through, if you have any questions, we have a small enough group here today that you can unmute. You can also put questions in the chat, and Cindy and I will try to monitor that as we go along as well. So let's just jump right in. Okay, so we're going to introduce what a reverse mortgage is. We're going to talk a little bit about loan qualifications and options, how it can be used. There's a lot of different ways you can use a reverse mortgage. What does loan maturity look like? What triggers that? And why Fairway? We'll go into that later at the end. So again, let's go through several different topics. And if you look across the top of the slide, you'll just see the various topics I'm going to get to today, as I just mentioned. So first and foremost, when we ask someone, what is your opinion of reverse mortgages? These are two of the things we hear. Oh, they're great. And then we hear, I've heard some bad things about them. I'm here to learn a little bit more about the facts, right? Everybody has had some, I guess, idea of what a reverse mortgage is, but might not truly understand the potential of what the new reverse mortgages can do for their clients today. So Wade Pfau, who's a PhD, does a lot of writing and books about how, when using a reverse mortgage strategically, it can really improve how long your retirement income will last, right? The number one fear of most people as they enter their retirement years is that now, with advances in medical science, am I going to outlive my nest egg, right? Am I going to outlive my income? What is that going to look like if I run out of resources? So we'll dive into how this can be a huge, like, cog in the wheel of your retirement planning. So if you're 62 or older and concerned about market volatility and inflation, your dollars today or later might not be worth as much as you think as you age. Outliving your savings, as I mentioned, is really honestly probably the number one concern for most people considering retiring. Making monthly mortgage payments in retirement, huge consideration. Are the pensions or distributions from savings going to be enough to allow you to live the life you want to live in the place you want to live? Not being able to continue to live in your home in a safe, sustainable way, right? What you're receiving might be enough for you to make your monthly obligations, but is it enough to keep the house up? Is it enough for necessary repairs or unexpected things that you would need as you age. Okay. So a reverse mortgage could be a solution to those things, and we're going to dive into that. So what is a reverse loan, right? It is a home loan exclusively for older adults. The one we are going to speak about today is the home equity conversion mortgage, which is an FHA loan program. And you've got to be age 62 or older to be eligible for that program. A reverse mortgage can convert a percentage of the equity in your home into tax-free cash. There are no required principal and interest payments on a reverse mortgage. You still have to pay your property taxes and your homeowner's insurance and any homeowners association fees as related to the property, but no principal and interest payments are required with the reverse. The HECM or home equity conversion mortgage is the most used reverse mortgage in the United States. At our company, about 95% of all of the reverse loans that we do is this FHA insured equity conversion mortgage. It's been around since 1989, but has been modified greatly and includes a lot of amendments that improve consumer protections in that mortgage home loan. It is the only reverse mortgage that is federally insured through the Federal Housing Administration. And again, it's exclusively for those age 62 or older. So aren't reverse mortgages just a loan of last resort? And when you ask someone, have you heard about a reverse mortgage? A lot of times that's an answer we get. They ran out of they want to stay in their home. They need some assistance staying there. They've run out of all of their savings, but they have a significant amount of equity in the property. We're going to have to consider a reverse. Okay. But it is so much more than a loan of last resort. It has tremendous appeal right now among those age 62 or older who are savvy investors and want to maximize the earning potential of whatever they might have in their 401k or other accounts, and use this as a tool in conjunction with those other assets. Okay. So the primary reasons to get a reverse mortgage, it could be need. I'm not saying for some it could be a loan of last resort. It could be need. They have to address an urgent need. Suddenly they need in-home care, right? So where is that extra money going to come from to pay for nursing to come into the house, perhaps? Maybe it's for lifestyle enhancement that they need it for. Their pensions are providing an adequate sustainability in their day to day, but they want to travel or they want to do something else or they want to help their grandchildren and they need access to funds that they don't have to make payments on. They want to pay for things that are not in the budget, like I said, for travel or for financial planning purposes. They want to maximize their cash flow monthly. They want to reduce tax implication that of withdrawing out of other assets, and they want to minimize risk. And again, this isn't tax advice. We are not accountants here on this call. We're just talking about the reverse mortgage as a planning tool, and we're gonna show some examples as we go forward. So some of the pros and cons, right? The pros are it is a source of cash flow monthly, or whenever they want to use it. There's no monthly mortgage, principal, and interest payments. You, again, still have to pay taxes and insurance. You have to maintain the home. And it's a non-recourse loan. And we're going to define non-recourse later on. Okay. The cons are it is designed for those age 62 and older. There are interest and fees that chip away at the home equity because think of how your credit card works. If you charge on your credit card and you make your minimum payment next month, you are going to have additional payments going forward, right? It's going to compound. Your balance is going to grow. That is how a reverse mortgage will work as well. okay? It has to be your primary residence. You have to live there. It is only available, remember, it's an FHA loan. It's owner occupied only, okay? Not for investment property, not for second homes. So let's talk about some of the myths, right? Myth one, the bank will own my home. No, you will remain entitled on your home just like you do now. Okay, there's nothing changes. You are in control of your destiny with whatever you want to do with that home. Okay, it's not like the title is given over. You are the owner, you are in title. My heirs will be stuck with a big bill. Absolutely not. You or your heirs will never owe more than the value of the home after the loan matures and the home is sold. Okay, so the bottom line here is the property will always satisfy paying off the existing loan, regardless of if the property is worth less than what the balance of the loan is. That's what the insurance is for on the loan. Okay. I must own my home free and clear to qualify for a reverse mortgage. That's not true. It helps in terms of how much you can get, but you do have to have a significant amount of equity in the property. Um, Usually, depending on your age, 50 to 60% equity in the property would be needed. If you have sufficient equity, you can pay off any existing mortgages at closing using the loan proceeds, meaning let's say you have a property that's worth $1 million and you owe 150,000, okay? And you just don't want to make payments now. You can take out a new reverse mortgage, extinguish the payments on the loan, replace it with a reverse, and not have principal and interest payments any longer. So let's talk about some of the loan qualifications and options and kind of what we look at. Again, who qualifies? Age 62 or older, has to be the homeowner, has to either own the property outright or have, as I mentioned, a significant amount of equity in the home. It's your primary residence, and you have to meet minimum credit and income requirements. So, what does that look like? Okay. The eligible property types: single family home, 2 to 4 unit properties of which you occupy one of the units. Townhomes are fine. Condos have to be FHA approved. There is a possibility if the project is not FHA approved that we could perhaps do a single unit approval. So that is a possibility. Plan unit developments, as many of your townhomes are in, but sometimes you have row homes that are not in HOA. Modular homes are okay, and manufactured homes as long as they meet FHA requirements. Okay. So, how much home equity do I need? So this gives you an idea, right? You need roughly or at least about 50% home equity, and much depends on your age. Okay. So the older you are, the less equity required. The younger you are, the more equity required. Because from the bank's perspective, think about it. The loan is negatively amortizing, it is growing over time, and it's based on actuarial tables as to how long reasonably, based on your age, you might remain in that property. Okay. The borrower can bring funds to closing. So if you had a situation where the borrower didn't have enough equity in the property, but they've spoken to their financial planner and they really want to extinguish their current mortgage and replace it with the reverse, but they don't have enough to do it, they can bring cash to closing in order to make the transaction happen. Just like basically if they were purchasing the property from themselves. Their goal here would be the power of the reverse over time and why they would want to do that instead of waiting. So how much can you get? Again, it's based upon the age of the youngest borrower or non-borrowing spouse, the interest rate you get on the loan, the lesser of your home value or the home equity conversion loan limit of 1,089,300. So that is the national loan limit on this HECM, $1,089,300. Okay. So we've had some people, like I spoke to a financial planner last week. She said, Kelly, I have a borrower whose home is 3.5 million. And he's interested in looking at a reverse in terms of extinguishing the payments on it. He doesn't care that the balance is going to grow over time. He already has 2.5 million in equity in the property. He would rather not make the payments and use those payments for something else. So again, it's not just about, a smaller loan or something like that. If you think about the high-end wealth client who doesn't necessarily want to draw down from accounts that he or she would have to pay tax implication on, but would rather access the equity out of the property, it comes in at 100%. There's no taxes paid on it. It's not income. It's a loan. It's just a loan secured by your property in reverse. So here's an example, right? How much can I get? So let's do an example. We have a borrower whose age is 74. We have the expected rate, just for example's sake, is 5.5. Right now it's running around 6 3/8 on the reverse, but for this example, let's use this. We have a home that's valued at 600,000. And when you look at the borrower's age on the grid at 74, and you look at the expected rate at 5.5, we have something called a principal limit factor, or principal factor limit of 45.80. So they basically take that and multiply it by the 600,000, and the available loan proceeds for this reverse candidate initially upfront is 274,800. Okay. So how can they use that money? Okay, let's assume they were able to get that. How could they use it? So you've got three buckets of wealth, right? You've got the wealth that you've created between age 18 and 62, which is your monthly income, right? Your wages, your commissions, your business earnings, your pension and social security. Okay. Then you have bucket two, right? Which is 5 to 20% perhaps that you've saved for your retirement. This is your nest egg, right? You've been putting into this for time after time after time, thinking it's going to be enough. It's going to be enough to cover whatever might come up, right? So this constitutes your 401ks, your stocks, your bonds, any lump sum savings, life insurance plans, IRAs. This is what we consider your supplemental income, right? And bucket three is your down payment, your monthly payments, your maintenance. What does your home equity look like, right? It's your home and it's your real estate equity. Is it working for you or is it sitting there? Okay. And that's the question. So now, how can we use the proceeds of this reverse mortgage that we just calculated? Well, you can do a single disbursement lump sum. So the home equity conversion mortgage is a line of credit. Okay, it's not, there is a fixed option, there is a fixed rate option. It's not as versatile, or it will not yield you as high a loan balance as the line of credit will. And the line of credit gives you a lot of different options. So you can get a one-time lump sum. Okay. You can get monthly fixed advances. You might want to say, I've got my pension of X, I've got Social Security of Y, I'm falling short, I want 1,000 a month. Let's calculate, can I do that? And then that comes in right into your checking or savings account, 1,000 per month until you change it. Okay. It could be a situation where you just want to set up the reverse mortgage. You don't necessarily want money monthly. You just don't want to make mortgage payments on your current house. Okay. And it'll sit there, and anything that's available on the line of credit can be tapped into at any time. Um, should you need to buy a car, let's say, and you don't want to take traditional financing. Or you can look at it as both monthly advances and a line of credit. So in the case where, so this is getting a little deep, but in the first 12 months of a reverse mortgage, you're limited as to how much of that line of credit you can access. In the example that we just brought up, the borrower was eligible for basically 275,000. Okay. They would not be able to get all 275 in the first 12 months. There's a limitation because what was happening many years ago is people were refinancing their mortgages to reverse mortgages where we don't escrow for taxes and insurance. They were getting all of the cash, and then they stopped paying their taxes and insurance and the property went into default. At that point, FHA would have already issued all of the proceeds, right? Not knowing perhaps if they would be able to recover all of that if the borrower defaulted. Chances are they could, but there's carry costs then to the lender of marketing the property, et cetera. So they put some safeguards in as to how much the borrower can get in the first 12 months. And then after the 12-month goes by, the rest of the available equity line opens up and is available for use. Okay. But in this screen, I talk a lot about my mom on these calls because they always owned the house free and clear. My father passed away in 2006. My mother took out a reverse mortgage in 2008. She wanted a cash disbursement of 35,000. She wanted to do some improvements to the house, put a new roof on, do some things, and then she wanted a monthly stipend. Okay. So, my mom now has been on this reverse mortgage for 16 years. She's 93 years old. She continues to get her monthly stipend. Okay. Because dad passed, Social Security gets reduced, et cetera, et cetera. And it has just been wonderful in terms of her quality of life. So the unused portion of the line of credit will grow over time, unlike home equity lines in the most recent past when you had a real estate bubble and properties devalued suddenly. You had lenders out there reaching out to their customers saying, yes, you have a $150,000 home equity line of credit. We are capping your access at 100. And suddenly the line of credit you thought you have is no longer accessible to you. Okay. That cannot happen on a reverse loan. It will grow over time. If you use your line of credit and you are commissioned, let's say, and you say, you know what, I'm going to use my reverse mortgage all year. I don't know how much money I'm going to make this year. In November, I'm going to take a lump sum and I'm going to pay back some of the reverse mortgage. Okay. You still have access to that line of credit from the beginning. It doesn't get reduced. It will never get reduced. There isn't anybody that will come back at you and say, sorry, it's not as big as when it was when we started. Okay. So your line of credit will grow at the same compounding rate as the loan balance. So if you started with $100,000 loan balance, you paid down 25,000 on it, you're now at 75,000. You still started at 100, and that will never be reduced. Okay, it will continue to grow. So you have greater borrowing capacity over time as you pay it, use it, pay it, use it. It's secure. As I mentioned, it can't be capped, it can't be frozen, it can't be eliminated due to market conditions, unlike traditional HELOCs. And it's liquid home equity. It's, your house is kind of like your ATM here. It can be borrowed, paid back, and borrowed again, right? Constantly used and reused, and still provide the benefit of not having to make a principal and interest payment monthly. You get to decide. So here's the line of growth. If you took a 62-year-old borrower and the value of that home was 600,000, and let's say the Available line of credit for this borrower was $223,000. Okay. What does the value of the home look like in 27 years when that borrower is 89,000, right? Estimates would be 1,024,000 of value. The line of credit over that 27 years now would be 1,026,643. It just goes to show you that that line of credit will continue to grow over time. So again, many uses of a reverse. You can refinance the standard mortgage, as I mentioned, eliminate those monthly principal and interest payments. You can use the available line of credit as a standby for portfolio protection. So let's talk. This to me is like the aha moment for me. Okay. You can use a reverse mortgage to enhance cash flow in economic downtimes, which can make your investments last longer while net worth will not necessarily decrease. So let's just think of this a second. Let's say you have a great financial planner, and I know Cindy does. You have a great financial planner who's doing wonderfully with assets you have over here in your portfolio, right? It's um, maybe they're making you, let's just say 12% on what you have in there. Let's just say that. Okay. And you're in a home that could be appreciating 5%, could be appreciating 15, 12, who knows, right? But you might, for planning purposes, say at a minimum, my house should be appreciating 4 to 5% a year. Let's just say that. Well, in the end, whoever has the most money wins, right? What that money is composed of is what is the difference. So if you say, I want to eliminate my principal and interest payments because I would rather get tax free money, let my house balance go up each year, have the money I need to live on along with my social security or my pension, right? Because over here, my financial planner is making me 12%. My house is only making 5% a year, maybe 8% or whatever. So keeping my money here with my financial planner gives me more net worth at the end than using my assets that I get taxed on if I have to pull them out for any unknowns or making my mortgage payment or whatever the case may be. But what you could do annually with your financial planner is decide when is it better to use my reverse mortgage or liquidate an asset, right? Your financial planner might say, you know what? Let's sell this asset. It's at a loss. Take the loss. That's what we're going to do this year because, from a tax perspective, it's better to do that than this. Or they might say, you know what? We're on a roll this year. We don't want to pull anything out. We don't want you taxed. You had a great year in commissions or whatever. Your tax basis is high. Use the reverse mortgage to live and not have that tax implication in this year, right? So it's a huge conversation with financial planners who can really see the power of choice and when to liquidate an asset or not. Okay. So again, I know a lot of people as they age say, I want to leave this to my children, or I want them to have it, or I'm just proud that I don't have a mortgage payment. I worked so hard to pay my house off. Why would I want to do this? Well, you need to work with your financial planner because your children or your heirs are not going to care where the money comes from. They might not want to be burdened with selling a house in order to get that equity. If you could have kept it in accounts that they would have received upon your death regardless, right? So it just makes you think about your assets a little differently and your financial and estate planning a little differently. You can increase your cash flow to close a retirement income gap, right? I turned 61 this Saturday. If you're turning 62 at this point, your maximum Social Security benefit kicks in when you retire at 67, right? But when you started working at 18, 20, 21, 25, whatever it was, you thought it was going to be 62, and times have changed. So now you're like, okay, but I still want to retire at 62. How do I close the gap between getting my pension for Social Security at 67? Do I look at this to close that gap, still retire at 62, live off of the reverse mortgage, and then start taking my Social Security at full benefit at 67? You get a lot of people who, want to get to the Medicare age, right? And they're working and they might have an insurance plan. They might say, well, at 63 and a half, I might be able to Cobra, leave my work, pay the insurance cost for 18 months, because that's the maximum Cobra, I believe, get to 65, get on Medicare, get my supplements, and still use my reverse mortgage and not take my full Social Security benefit till I hit 67. So again, this is about options, right? It lets you think a little differently about your quality of life and how to use your assets effectively, right? You want to get the most lifetime value from your Social Security benefits, right? We all do. You might want to help your family now. You might want to give gifts. You might want to donate to charitable organizations, help your grandchild or your nephew, niece, child buy a home. It could be used as a wealth multiplier. And that's why I say financial planners love this program, because they understand the power, one, of not liquidating assets on a regular basis, because the one thing they can't control is the market. And they can't tell you necessarily when is the best time to liquidate, but they can watch a market and know that if they have time, they might be able to put you in a better taxable position. You can use the reverse to pay for home renovations, assisted living in your home, and other big ticket expenses, right? You might love your home, but it might need renovations for as you age. Maybe you're in a wheelchair, maybe you're, in a push stroller, that helps you walk, and you might just need wider doorways, or you need bathroom renovations, as you age in place. Maybe you need walk, you have steps, want, railways instead of steps. It could be used to pay for long-term care insurance premiums. A lot of people need long-term care insurance, but they cannot afford the annual premiums on it. And if you've ever shopped for that, you'll know it's expensive. Okay. So a lot of different common uses for a reverse mortgage that wouldn't necessarily impact um, your monthly cash flow that you have from pensions and other items. Okay. And just so you know, average cost of long-term care. Home health care runs almost $60,000 for Alzheimer's, meal prep, light housekeeping, errands, and shopping. If you're in an assisted living facility, that could be as much as 54,000 annually. You've got on-site nursing, private apartments, and help with daily living. Now, nursing home care, if you shop this, again, these are averages across the country, 108,400 for private care. That's full-time in-facility care, advanced long-term care, therapy, rehab, medication, skilled 24-hour nursing. So Medicaid is only going to pay for shared rooms right now. 95% of people do not have long-term care insurance, and over 50% of people will need it. How else for financial planning? And again, like I said, I talk to financial planners every week. I want them to understand this program. It can help you to keep adjusted gross income low, because again, if you take distributions from your reverse mortgage, it is not income. It is a loan that's paying you. Okay. It'll make your traditional retirement funds last longer. You're going to hedge against market risk or sequence of returns on risk, right? Again, you're working with your financial planner. They're going to tell you when to take gains. They're going to tell you when to take losses. They're going to tell you when to sit tight, right? I believe in paying for expertise. This just allows you an additional tool so that you can maximize your wealth and your quality of life and minimize the tax implications going forward. And again, it can insure against longevity or pay for long term care, maximize other retirement contributions. So, why would you do this earlier than later? Okay. And you have a lot of resources here that explain why setting this up sooner than later is a benefit. Saks and Saks has a coordinated strategy. They say if you open in a HECM line of credit early, you have a 78% cash flow survival rate in retirement. You have a 4% post tax initial withdrawal rate based on a 32-year investment return, meaning up to like 94. Okay. They're looking at 94 in terms of if you started at 62 and you live to 94, you have like your best investment return, right? If you treat this as the equity of the home loan of last resort, okay, this is a passive strategy, but people do it. They're like, just they don't want to have a loan on their house. And I get that. I truly do. So let's say they delay the opening of a line of credit until their investment portfolio is depleted. And this is all that's left is the house. They have a 60% cash flow survival rate, again, based on 4% post initial withdrawal, tax initial withdrawal rate, and a 32-year investment return. Okay. So just delaying it reduces your survival rate by 18%. And if you do nothing and you don't take out the home equity line of credit at a 4% post tax initial withdrawal rate and you ignore the home equity, you're living in your house, you're not using the equity, your cash flow survival probability is 35%. So you can just see the power of it, even if you don't use it. Okay. You can see the power of having it and letting it grow over time as available for use no matter what might come. And it says strategies that open the line of credit early, but then delay using it for as long as possible offer increasing success rates as more of the line of credit was available to be drawn on when it was needed later in life. So it has the top consumer protections. Every HECM or reverse candidate has to be counseled by a HUD approved counselor before we proceed. We have to have that counseling certificate so they truly do understand the program. Remember, we can't have elder care abuse here, right? We have to be mindful in how we go through it. There are, as I mentioned, initial disbursement limits as to how much they can take out of the line in the first year, but then the rest of it will open up in year 2. There is a financial assessment. We have to be sure that the borrower can meet minimum subsistence levels to sustain their quality of life and have enough to cover property taxes and insurance. Okay, so we have to do a minimum financial assessment. There are non-borrowing spouse protections where if you have a situation where you have someone who's age 62 and you have a spouse who's age 55, well, the spouse is not eligible to be on the reverse loan, but they do have protections as a non-borrowing spouse. Should the borrowing spouse pass away, the non-borrowing spouse does have some opportunity to remain in the home. Okay. So the due and payable clause, which happens when the last borrower passes away in the home, could be deferred for that non-borrowing spouse. It has some protections there. It is a secure, the line of credit is secure, and the unused line of credit will grow regardless of the home value. And the non-recourse feature is always in place, meaning the heirs will never be responsible for for what is owed on the property. If there's a deficit and they, let's say the house is worth 400 and the loan is 450, the heirs to the house can say, take the house, and they're done. There's no shortfall that any heir is responsible for. The house will always satisfy the loan. You definitely can use a reverse mortgage to buy a home. We call this the H for P, home equity conversion mortgage for purchase, H for P program. So people can upsize, downsize, or right size into that ideal property. Most people in the reverse space, when they look at it for purchasing, it's their forever home, or they want to be closer to their grandchildren or family. Um, and again, their strategy might have been, I'm going to sell this big house and I'm going to buy my forever home in cash. Well, why would you do that? Okay. Your concern is you don't want to have mortgage payments, but what if we tell you you can do this, have a mortgage that negatively amortizes, yes. You don't have a principal and interest payment. You would have been paying taxes and insurance anyway. Why not take those proceeds either at 45% or 65% that you were going to just buy the house cash with and keep them invested with your financial planner and growing for you over here? Okay. You could always take them and pay the mortgage down, right? But why? Why wouldn't you have that nest egg over here growing and working for you and still not have a mortgage payment over here and get the quality of life that you so desire? So you would keep more of your retirement assets working for you compared to paying all cash. And again, you still don't have principal and interest payments. You would have been paying the taxes and insurance anyway on the property, and that won't change. I've talked a lot about the home equity conversion mortgage because that is the most popular reverse mortgage with the most protections to it in the country. However, I just want to mention that there are various banks across the country that have opted into what we call proprietary reverse mortgages. They are like homegrown reverse mortgages that they create. Um, there are they cater again to older adults. Typically, we see them for high property value homes. You know, as I mentioned earlier, the person who had a $3.5 million property, you normally wouldn't reach out and say, "Can I do this FHA HECM on that? Is there anything that's larger than that 1,089,000 limit that I could look at for reverse?" And there are some proprietary lenders doing that. Maybe they're in an FHA uh, or they're in a condo that cannot get FHA approved. So you have to look for a proprietary reverse loan for that person. There are some proprietary reverse mortgages in various states across the country, not all 50, where the minimum age of the borrower could be as low as 55 instead of 62. So there are some of those. And FHA loans do have mortgage insurance premiums as a component in the mortgage payment. That's what pays for those gaps in value and loan over time is the insurance. Proprietary loans might not have those mortgage insurance premiums. So very unique, very different, a lot of guidelines to them, but I did want to mention it because there are some lenders out there that do offer the proprietary program. And we have some, but that we work with for proprietary. So if we have a situation where your reverse candidate doesn't fit a particular scenario, let me know. We'll reach out to our reverse team and see if there's an alternative on the proprietary side that perhaps could work for that client. And then just loan maturity, what causes that property or that loan to be due and payable, right? Well, you could choose to sell your home and move. Just like on a regular mortgage that you might have now, if you sell the home, any liens attached to that property have to be paid off so that title can transfer. If you transfer the title to someone else, that is a due and payable event. Mortgage comes due. Okay. The last surviving borrower moves out of the property permanently, the mortgage comes due. Okay, now this isn't to say that we don't have snowbirds in the room that want to go and, go down to warmer climates during the winter months and then come back and live in their property. That it's still your primary property. I mean, that happens. So that's not what we're talking about here. If they default on the loan terms, if they stop paying property taxes and insurance, just like you would on your regular mortgage, that is a default. Remember, those personal property claims not being paid can supersede a mortgage claim and move that property to foreclosure. Okay, so that is a due and payable clause. And again, the last surviving borrower passes away, that would be a due and payable event. So how is the balance repaid? So let's look at this, right? The loan is not yet due and payable. So the borrower can pay as little or as much toward the loan balance as they wish each month, or they can make no monthly payments at all, right? So they have the reverse mortgage, they want to pay it down, or they want to keep the balance to a certain amount. They can do that whenever they want. There's no prepayment penalty, or they can not make any principal and interest payments ever. If that maturity event that we just talked about happens, the loan is due and payable, which means you could satisfy that loan via the sale of the home. Okay. They are non-recourse loans. As we mentioned, the sale of the home will always satisfy the loan repayment obligation. Neither the borrower nor the heirs will be personally liable if there is that balance deficiency. Okay. Again, property worth 400, but now the reverse mortgage balance has escalated to 450. The person passes away. The heirs don't want to buy the property. They don't want to keep the property. They can give it back to the lender and everybody is free and clear. So again, this is the grid as to what are the options for the heirs, right? First, is there any equity left in the property? Yes. Well, they could pay off or refinance the loan balance. They could do that. Or they could sell the home and pocket the profits as the heirs, right? Do they want to keep the home or do they want to sell it, right? If there's no equity left in the property, but you have heirs that just want to keep the house in the family, the heirs can purchase the home for 95% of the current appraised value. So in the case where the mortgage loan was 450 and the value of the home based on appraised value was 400, they could purchase that property for 380,000 or 95% of the appraised value. That's fine. Okay? So that's a benefit if the heirs want to keep it. If they don't want to keep it, they don't want to deal with it, they don't want to do anything with it, they can sign a deed in lieu of foreclosure and walk away from the home. Any questions on this part of it? So again, it has a lot of protections in here, not like it did when it first rolled out late 80s. Okay, a lot of protections in here. And again, just why Fairway? We are a national lender. We are probably one of the biggest lenders, and we just received an award for quality of service for our reverse team across the country. Again, Education is huge. That's why I try to get with Cindy and do this every month or every other month, because I think the more we talk about this, especially if you're a senior certified real estate agent, you work with seniors, you're a child of a senior that you're worried about what to do, you're, a brother, sister, whatever the case may be, you need to be educated on the power of this program as an option. Okay. And again, we want to be sure you have a great experience as you're going through this. And I think education is key when it comes to this program. And that's really all I had today. Feel free to unmute if you have questions. Happy to happy to chat.